On today's episode, I have Andy Greenstein, fellow lawyer at Hess Legal Counsel. Between the two of us, Hess Legal certainly, we've done a ton of crowdfunding deals and wanted to use this opportunity to share some things that we've learned along the way, but also to share an observation that I have about the state of digital assets offerings for small issuers in the U.S. It's the regulatory landscape, even no matter what you've heard in terms of new legislation, none of it really specifically covers the interests of the small issuer. There have been efforts, Hester Peirce's Safe Harbor, Lex Punk's Reg X, but the current legislation doesn't really focus narrowly on it. Notably, the MICA, the EU final rule, actually does address the need for assessing whether there's a disproportionate impact on small and medium-sized issuers. But in the U.S., we're kind of more focused, I guess, on the institutions and not as focused on the bootstrappers and the fair launch projects. So, in short, this episode was a long time coming. So it covers digital asset, it covers nuts and bolts of crowdfunding, and I think you'll get a lot out of it because there's a lot of knowledge here, and happy to share. So if you like it, share it with others, and we'll continue to build all the episodes and the knowledge base for everyone to enjoy. Thank you. Welcome to The Encrypted Economy, a weekly podcast featuring discussions exploring the business, laws, regulation, security, and technologies relating to digital assets and data. I am Eric Hess, founder of Hess Legal Counsel. I've spent decades representing regulated exchanges, broker-dealers, investment advisors, and all matter of fintech companies for all things touching electronic trading, with a focus on new and developing technologies. All right, so today on The Encrypted Economy, we're going to be covering crowdfunding, safes, and digital assets, both myself and Andy Greenstein from Hess Legal Counsel. Welcome, Andy.
Hi, Eric.
All right. So we'll touch on a little bit of background just so people know a little bit about you, and then we'll just dive right in. So you were Deputy General Counsel at Knight Capital Group back in the days when the flash crash happened, that exciting time. And actually, you were with them for a number of years prior to that. You actually had a lot of public company experience as well as strategic experience there. But I don't know, do you want to share anything from that time?
Sure. I spent 15 years at Knight Capital. As you said, did a lot of managed a group of 8 attorneys, and a lot of interesting aspects I dealt with throughout that time. Obviously, the flash crash was what most people talk about, and that was when we lost. There was a code programming issue, which resulted in a $400 million loss in about 45 minutes, of which we then spent about 6 days, me and a dedicated group of people in the office pretty much the whole time in an attempt to keep the company afloat, obviously, after such an issue. And, it was, although it was one of the lowest points in my career, it was also one of the most satisfactory at the end when we were able to survive literally with about 20 minutes left before the SEC was going to suspend our stock from trading going forward. And a lot of that was due to kind of, not burning bridges over the years with people who you dealt with and who were former employees and things like that. Ultimately, in our time of trouble, a lot of people came out from all over to offer assistance to us and help us in that incredible situation. And, ultimately we survived, which was great. Obviously, we got acquired about a month or two later. But one of the more fulfilling moments at the end when we did survive, and knowing we saved, a whole group of them saved about 1,200 people's jobs, and we're able to kind of keep a business afloat. So very exciting times, and also very sad at the same time, but a great experience nonetheless.
And so years later, you went from, I guess, the frying pan into the boiling pot with Lebenthal.
So I was general counsel and kind of came towards the very, unfortunately, unbeknownst to me in many respects, when their business started to struggle and had some kind of shareholder issues, which resulted in some departures of key backers of the business. And there, another issue, situation of crisis management and trying to work with people to kind of salvage the company, negotiate kind of settlements and releases to kind of land it gracefully and a graceful exit, which we ultimately did. I mean, it did file for insolvency at the very end from a legal kind of maneuvering type of situation, but there's a lot accomplished there. But yes, have a lot of crisis management experience in addition to obviously capital raising and just regular corporate governance and the more traditional M&A work that we do as well.
Excellent, excellent. So, not to minimize all the other strategic deal experience that you've had along the way. Certainly, since joining Hess Legal Counsel, we've done a large number of deals, both Reg CF, crowdfunding deals, Reg D work. You've assisted on other stuff related to Reg A here and there, but certainly. That's what we're going to talk about today. So we can dive right into it.
That sounds great. Thanks.
So a little bit on my or Hess Legal's fascination with crowdfunding and why it's particularly relevant. So before crypto, I was actively involved in lobbying for the Jobs Act, maybe about 10 years ago or so, when I was general counsel of a U.S. registered stock exchange known as Direct Edge. Direct Edge was acquired by Bats. Bats was acquired by SIBO. Just the way things go in this space, right? Also tried to create a new over-the-counter trading markets, much like the pink sheets. ATS, broker-dealer. We had filed to become an ATS. Ultimately, for other reasons, it didn't work out. But, basically, this has been sort of the early stage space has been a passion of mine for some time. And, when crowdfunding finally came out, it was great to finally start getting a lot of referrals. I mean, we've probably done over 100 of crowdfunding deals. We've done a lesser number of other types of securities registration exemption deals like Reg D, but it's hard to beat 100, even if you do a ton of Reg D deals. So we come into this episode wanted to talk about what we've learned from all our crowdfunding experience, also to talk about the significance as it relates to digital assets. What we're going to cover here, we're going to talk about what these financings are, how like a Reg D and a Reg CF work together and facilitate formation over time, and a detail that is not covered enough, I think. Also wanted to touch on how it all relates to fair launch digital assets that are building communities in the U.S. And how they really need to consider the crowdfunding option, even if they get VCs, angels, what have you. Again, use complementary with those, but it's very important. So why are we doing this today? Why didn't we do this like a year ago or so? And I'll get into it before we launch. So the SEC has taken a broad view on what constitutes a security as it relates to digital assets. Obviously not something that I particularly agree with the broadness of it, but nonetheless, it is what it is. And a lot of projects that I see, the Hess legal practice has I do a fair amount of the digital asset work. Andy does a fair amount of the crowdfunding work. We work collectively on Reg D and other types of financings. He works on digital assets. I worked on crowdfunding. But there are two reasons why this is particularly compelling for digital asset projects operating in the U.S., particularly early stage startup. One is regulators, in my view, certainly haven't shown themselves as coming to the rescue, nor has the legislators. If you believe that Congress is going to take action on stablecoins, protocols, nothing has really been said specifically about assisting early stage fair launch crypto projects. And they're facing potential designation if they're trying to launch a native token to be a security. The Wild West narrative that's come out of Washington and the regulators has really been to the detriment of small to medium size. And when because Wild West means you need a lot more controls. Those controls are often a barrier to entry. I was reading the Loomis Gillibrand bill this morning and the Stabenow, the Digital Commodities Protection Act, and there's a whole slew of others. But one thing is pretty clear is that SMEs, small to medium sized enterprises, really just isn't mentioned in it, and it's not likely to to gain traction in Washington right now. The focus is much more on the more institutional or the institutionalization of it under the premise of controls. I contrast this with MiCA, which is the European rule regarding digital assets that just got in final form. Presumably, there's still some negotiations, but what's very notable there is they do specifically call out the concerns of disproportionate impact on small to medium-sized enterprises, as well as the burdens. And furthermore, they also call for an assessment to be undertaken to fully understand that impact. Again, which is something that the U.S. has so far has not done. Now, the Jobs Act took years to happen. And there's nothing like the Reg crowdfunding or Reg CF that would specifically help digital asset projects looking to leverage their community. So at any rate, one is the regulatory construct. The other one is, quite frankly, the efforts of small to medium-sized companies to achieve sufficient decentralization. There's no such thing as an immaculate conception. Almost any path to sufficient decentralization probably requires walking through the valley of centralization, and thus you run into the risk of being a security while you hope at some point to achieve sufficient decentralization to not be. I think that's it's too challenging of a path. I think the regulatory environment in the U.S. is too challenged. Just because a company proclaims, or a group of people proclaims themselves to be a DAO, does not mean they are truly DAOs, and which is why like Hester Peirce's safe harbor proposal or LexPunk's Reg X proposal were so critical. They're just not getting the uptake that they should. So with all that being said, you had the Uki DAO complaint last week that uncovered some of the issues with trying to be decentralized. And so, despite how you may feel about it, it does seem like this is not the time for small to medium-sized companies, particularly in the early stage, to launch a native token in the U.S. if they have developers in the U.S., if they have a project team in the U.S., if they've got investors in the U.S. It all doesn't seem to be particularly a good time to do that. So, with all that said, I believe that there is a strategy for these early stage digital asset projects. And obviously, we're not confining our talk today just simply about digital asset fair launch projects, but I think it's also important to consider these projects. They should now look to crowdfunding if they want to leverage their communities, because crowdfunding is phenomenal for that, as we're going to get into, and think about coupling it with a strategy for doing Reg D for, if they want to raise larger amounts, and deferring this notion of potentially having their native token trade on the public blockchain as a way of raising capital. This may be controversial to some people. It's not forgetting the space. It's not forgetting those challenges. I just think as a early stage startup, you don't necessarily need to 100% do it, but you should definitely be contemplating the value of leveraging your community through crowdfunding while coupling it with a Reg D strategy. So with that said, that was a lot.
Just to jump in for a second, we do have, as you know, several clients who are kind of taking that approach, who are in lieu of maybe doing a direct native token offering for now, are raising capital through the holding company instead under Reg CF, and leveraging their community and trying to build their community at the same time, which hopefully then will help them for a later subsequent token issuance down the road.
Right. And I think one thing that that's going to resonate through this episode is with regulation crowdfunding, they're not all effective. Particularly where a project or a company, we'll just say they have to be a company, so where a company doesn't have a community to bring. In other words, if you don't have the reach, just simply launching on a crowdfunding platform isn't going to make all these investors magically appear out of the sky, particularly if you've not done anything to cultivate that community. But what's critical for companies that want to build a presence with their community through the offering, or give non-accredited investors or other participants the ability to be to get a stake and to become their advocates. Crowdfunding is phenomenal in a way that Reg D and others may not even accomplish. Sometimes I even tell clients, like, if they're doing a Reg D, think about your community. You may actually, even if you can raise all the money through a Reg D, and we'll get through the importance of a Reg D versus CF. Contemplate reserving a little bit for a crowdfunded option where you can leverage that broader base community.
Yeah, and just to touch on that, if I can, for a second, to that point, obviously digital assets, new and exciting area. Maybe not that new anymore, but exciting area. A lot of people are involved in, but the demographic probably tilts towards a younger demographic, which may not meet some of the requirements for Reg D investing, aka accredited investor, in definitions. And the Reg CF may be a great alternative to reach that community of people that couldn't be reached otherwise, and help build the community, as they say.
All right. So now that we set the table, let's start to break it down, because for some people they may not even know what Reg D or Reg CF, and it's just words. So let's start to break it down. So there are some critical questions that we have to break down. We have one: what is an accredited investor? Most people know what an accredited investor is. We also have to talk about a SAFE, or what is known as a simple agreement for future equity. And what this is an agreement that really simplifies the process of an early stage company that doesn't know their, how they want to price their securities. It's really a way of saying, hey, we're not pricing it today, we're pricing in the future. And then, of course, we also talked before briefly about Reg CF and Reg D. So, Andy, easy question, softball. What is an accredited investor?
Well, maybe I just step back for 1 second. Just say overall, securities laws are designed for either registrations or exemptions from them. And there's splits between kind of accredited investors and non-accredited investors. Accredited investors deemed as sophisticated investors that may not require as much protection, so to speak, versus non-accredited investors who deemed to need more protection, which may be in the way of disclosures, additional disclosures, information that's provided to them, and the like. So with that being said, accredited investors is usually defined as a person who has an average annual income of over $200,000 or $300,000 if it's joint income or jointly married for the last 2 years, or a net worth exceeding 1 million, either individually or jointly as well.
Great. And then we talked a little bit about what a SAFE is. And the SAFE originated from something that Y Combinator did. Y Combinator was I don't think I want to go down the road of defining what Y Combinator is, but they basically they were nurturing early stage companies, and they created this open source version of an agreement that quickly became the standard for a lot of venture raising. And there are some variations, but I'll let you pick it up from there, Andy.
No, that's true. And, obviously safes are a good way for early stage companies to kind of get investors involved without having to go through more complex negotiations as far as determining value, lots of documentation that may be behind it, whether it's investor rights agreements, loan agreements, right of first refusal agreements, and the like. And so it's just a simpler way to do it from the outset, less costly and time consuming as well, which is important for startup companies or early stage companies who don't want to have to go through that process. It also kind of takes out the whole process of figuring out exact valuation. You usually set up a valuation cap, and it also helps the kind of from a governance perspective, the of founders and management. It allows them to continue operating the company since safes don't have voting rights to start. And so it's it's a great way at the early stage to maintain control, be able to execute on your strategy while bringing in necessary capital to fund your business. And I would just say there's kind of three pieces, that are generally key to a safe. One is the valuation cap, which determines kind of the value that your conversion is going to be based on. when your safe is ultimately converted into equity of the company. And so that's an important piece, obviously, because that gives you the upside. So if you do something today and you think the stock, the company's going to dramatically increase in value, you're locked in at a lower valuation cap. You get the upside going forward. So you get the same protections as if you had equity at the start, in that you're going to be able to get the upside. The other piece is a discount rate, which is usually a discount in the event there's a down raise following your issuance of a safe. So, for example, you got a safe at 10 million. All of a sudden, there's a down raise at 8 million, let's say, uh, or more. And if you had a 20% discount rate, you would really begin it at 20% from the down rate at 8, so it'd be at 6.4. So you get the benefit of a downside protection, which is important for a lot of companies, for a lot of investors, I should say, not companies, who want the protection of taking a chance on an early stage company. Now, as we've seen in the past, companies that kind of grow up in value very quickly, I think the discount becomes more important for people than others, for investors than other things. But it's an important piece, and you see it in about, I'd say, 40% of what we see on like the Reg CF side. People offer a discount rate, but it does depend a little bit. There's also a final piece that sometimes people offer, most favored nations clause, which gives you the best terms if there's a subsequent equity financing, and it's a better, gives you those terms. So fully protects someone for valuation and everything else that comes with it.
Yeah, I mean, certainly safes in the last over the last decade have been seen as more of a way to participate on the upside that's beneficial possibly for the company. I'd say, particularly as they deal with a slower economy, it still incentivizes investors to come in because of the because you get a discount and it's priced in the future, so you don't have to
Yeah.
worry. Like if you put your money into a public company and then the price goes down, not so great. But if you put your money into a safe, price goes down. If the company's still solid and they do a price around at that point, as an equity holder, you convert at a basically at a better valuation, and then if they bounce right back up, you're in a good position. So, I actually remember the days when there weren't safes, and it was a very different
You and me
conversation.
both.
It's just yeah, it's so amazing how like and not surprising how safes is just like, yeah, of course, if you're early stage you're going to do a safe, but before the Y Combinator came out with it, it was you had to price it. And typically, I'd say, I mean, a lot of the same dynamics would apply if you were a company and you had, a lot of leverage. You'd be able to get a higher price around, but you spend a lot more time talking about the pricing and
Yeah.
other negotiating factors. And it just like you could burn a lot of time on lawyers,
Yeah.
and safes just basically you can sign a safe like without any review. And
Yeah.
so when you go on like a funding portal site and you buy a safe as an investor, you really like the most important pieces are already provided for, which is around valuation, and you're protected on the you have upside with the valuation cap and the discount, but you also have downside protection. So
Yeah. I
a,
would
a
also
great
just say
innovation.
that in addition, obviously it's standardized as you mentioned, but they do vary a little bit, depending on if it's kind of a private safe, which are more in line with the Y Combinator and generally pre post money valuation caps they use, whereas kind of some of the platforms that are used for like a Reg CF, for example, may be pre money. Like for example, Republic uses a pre money valuation for theirs. So there are some different flavors to it, so to speak, and are somewhat customized in that regard. Also, like Republic doesn't do like an automatic conversion upon an equity financing, versus kind of a Y Combinator one. So there are some differences, but in the end, when it's all said and done, a safe is a much simpler document and instrument to use to raise capital at an early stage for a company, and that's why it's so attractive to people.
Yeah, we'll be raising Republic as an example. We work with all types of crowdfunding, but we're bullish Republic. So anyway, so let's talk a little bit about Reg CF. You know, CF is an exemption from the full securities registration requirements of an offering, but there are requirements.
So, Reg CF, all the transactions must take place online, usually through either a broker dealer or what's called a funding portal. Um, the maximum aggregate amount that a company can raise within a 12-month period is $5 million. Recently, there's been some changes as far as kind of, and we'll get into this a little bit later, as far as amounts can be raised with audited financials, which is the 5 million, and reviewed financials, which is a different number. And we'll get into that in a little bit. There's also limits on the amounts that unaccredited investors can invest across all crowdfunding offerings in a 12-month period. The nice thing about Reg CF Form C, which is filed, is it's simpler disclosures, not nearly as involved as a S1 public company type of registration statement or a Reg A offering statement, so to speak. And the other piece that's important to know is that although it is filed with the SEC, it's not something that requires pre-approval and clearance from the SEC prior to filing, which helps as far as kind of minimizing the amount of time it takes to draft and file a Form C versus if you were doing like a Reg A type offering or a Form S1, which can take many, many months and lots of back and forth with the regulators. These things can get reviewed after by the regulators, but again, not required beforehand, which goes back to the whole concept of ease as far as cost, time, and everything else that goes with it.
Right. And like with regard to ease, all the transactions must occur online. There's no calling up your broker and participating in Reg CF unless they give you a link to an online platform. What's interesting is there's a maximum aggregate amount within a 12-month period of 5 million, but that's 5 million through crowdfunding. So you could raise substantially more through Reg D offerings during that time. And then after the 12-month period passes, you can raise another 5 million. So, you can continue to raise money through the crowdfunding. And for a lot of early stage, those limits are completely doable. And even the limits on unaccredited investors apply within a 12-month period. So when you think about it, the accredited investors, you're arguably not limited because you can still go to Reg D. But for unaccredited investors, those limitations are going to apply within a 12-month period because there really is no other viable way. I mean, you can do it through Reg D, but for all practical purposes, really making a public offering to unaccredited investors, Reg CF is generally a preferable option, and we'll get into why. So let's talk a little bit, and that gives us a good jumping point for Reg D. Andy, why don't you introduce Reg D?
Sure. Reg D obviously is exemption from the securities law from registering your securities. It's a very common regulation that people rely on to raise capital in a private setting. Most typical is what's called a 506B, most call it, where you can sell to an unlimited number of accredited investors in a single offering, and a limited number of non-accredited investors. So it's usually if you involve non-accredited investors in a Reg D type of offering, then that will require a private placement memorandum be provided and drafted as part of that, which gets into kind of, it's more thorough, more complicated, more expense and time to do. And so it can, at times, we prefer kind of doing most of our 506B offerings solely to accredited investors. It makes it a lot simpler for the issuer, a lot less potential liability exposure down the road, and it just avoids kind of potential missteps that could come along the way and gives you more protection. So from our side, we generally recommend, not saying we don't, we say never do it, but we generally recommend doing Reg D raises to accredited investors only.
Right. And there are restrictions as a purchaser of Reg D as well. Generally, if you buy restricted securities through a Reg D, they can't be sold for at least 6 months, generally a year, before they can be registered. And then, Reg D, it doesn't permit a secondary market. It does permit private sales, private resales.
Yeah, that's true. And obviously, the one thing I should probably also mention too is Reg D is a simple filing as far as a form that you file as far as how much you're raising. PPM is not filed publicly or with the states, depending on where the capital raise is, and it's a very simple filing as far as it goes. Obviously, you still have anti-fraud provisions that you got to comply with, and you want to avoid violating those. for potential implications that you would not want. Um, the piece about the secondary market is very important because you are limited as far as what you can do, and it had to be in a private transfer after holding periods of 6 or 12 months, depending on the rule that you're relying on. The other piece, the PPM, as I talked before, you'd have to draft that. There are some financial statements that most people require or forecasts, but it's a little bit different than a Reg CF, for example, where um, financial statements are required. Now, obviously, the level of it, whether it's reviewed financials, audit financials, or self-certified, depends on how much you're raising. But again, it's not, a little bit different standards is what it comes down to.
Right. While there are a few different categories of Reg D, the most important thing to take away as a listener is for accredited investors, it is it's an optimal way of raising you're not subject to limitations as you are under Reg CF.
Yeah.
And if you want to do non-accredited, probably not as how should I say, not as elegant, I think, as Reg CF, although you can do it. Don't, anybody listening to say, hold it, you can solicit accredited investors. Yes, you can, but you have to, the verification requirements are much higher. And we're already complex enough on this podcast, on this particular episode. So we still have to get through the rest of Reg CF. So
Yeah, let
we're
me
going to
just
move,
add
move.
one other thing, Eric, to the Reg D piece for a second is, obviously we just talked about just one part of Reg D, 506B. There's obviously other pieces to it. There's also Section 4A2, which is a broader, Reg D is kind of a subset of 4A2. So, for example, safes that are done in a private transaction, for the most part, are actually done outside of Reg D, unless they're done through like a accredited investor platform or something like that, and they're done under Section 4A2. So I just wanted to make sure if anyone's listening, we are aware of all the different exemptions, but just want to point out some of the nuances there.
Right. So let's turn back to Reg CF.
Right.
What can non-accredited investors invest in? There's been some recent inflation adjustments. Who knows if they can keep caught up the way inflation's going? But what are some of the limitations?
So non-accredited investors who earn less than 124,000 in annual income or net worth, they can invest $2,500 or 5% of their annual income or net worth, so whichever is greater. For those that make at least 124,000 in annual income or have net worth above that, it's 10% of the greater of your annual income or your net worth. So you do have some limitations, and as you pointed before, it's across all your crowdfunding investments that you've done over 12 months. So it's measured along that.
So now I said earlier the maximum amount you can raise on an annual basis is 5 million, but there's a catch. You have to get a financial audit by an accounting firm. If you say, "Hey, I'm a startup, I don't want to get a financial audit," well, the Reg CF also works for you, but there's certain limitations. Do you want to go through those?
Sure. We'll briefly go through them. So these days, you can raise up, as you said, 5 million with audit financials. As of September 20th, 2022, the SEC, as you noted, did an inflation adjustment. So now you can do what's called reviewed financials, which is a lower standard than audited financials. So a lot easier to prepare and comply with. Usually you do GAAP financials, and then you have it reviewed by a third-party accounting firm. In that instance, you can raise now up to $618,000, or excuse me, let me step back. 1.235 million you can raise up to. If it's your second offering of a Reg CF, you can, if you're only going to do reviewed financials, you can only raise up to 618,000. And then obviously, if there's something below 124,000, you can self-certify, but we don't see that anymore. During COVID, it was at 250, and we did see some of those, but that's thankfully no longer applicable. And so again, just so I don't confuse people, it was 1.235 million up to for reviewed financials if it's your first offering on Reg CF. If this is your second offering on Reg CF and you're not doing audit financials, the max you can raise is $618,000.
So I know I foreshadowed it in the opening, but let's just talk a little bit about the different strategies of using Reg CF and Reg D collectively. What have you seen that works particularly well?
Obviously, what we've seen is, you know, people sometimes they do a mix of both. So, for example, they'll do a Reg CF offering, to go after kind of accredited and non-accredited investors, especially if it's towards their demographic and the product that they have is more towards that demographic. It's a great spot to be, and they'll raise that because obviously, as we noted, ease, compliance, costs, governance reasons, things like that. It's a great opportunity, but they'll also generally supplement it, whether it's before they do a Reg CF offering, concurrently with the Reg CF offering, or after with a Reg D or a Section 482 type offering, for which they will raise separately to generally accredited investors. And so we'd see a mix. Like I said, on the private capital rise under either Reg D or 482, that's usually done either in a private context with no solicitation. It can also be done, obviously, with a solicitation privately also. And then there's the third component, which you're seeing more and more of these days, which is kind of accredited investor platforms that are out there that are, whether it's like a Seed Invest or a Republic or some others that are trying, doing these accredited investor platforms. They have their communities for which they offer certain of these, issuers under the platform for people to invest in. So you see it kind of a mix, but as I've always said, I view all these as kind of not mutually exclusive. So you can get, as most people know, if they're early stage issuers, you're looking to raise capital from all over. So it's a great way to kind of access different areas. So you can do a, Reg CF offering on a portal. You can do a private raise under Reg D, and then maybe you want to do something on an accredited investor platform also through a third party and raise capital in a number of different ways.
And so one doesn't preclude the other unless they find out about you through the crowdfunding. So maybe we talk a little bit about that.
But yes, you're right. You can't obviously, if someone learns of your company through a Reg CF offering that's been on a portal, they can't go to you as an issuer and say, "Hey, I want to invest in you privately," and you take their money immediately. You'd have to stop the campaign, wait 30 days. There's a bunch of different rules that come into place. That's when you get counsel to give you advice. But it's there are some rules, and you got to be careful of misstepping and falling into some securities traps that are out there. The other piece I just should have mentioned, though, that's important is a lot of early stage issuers, they don't start with a Reg CF. They've probably raised capital either from friends and family or through maybe some issuance of a safes or convertible notes or some small common or preferred before they get to that stage. And then they start the process then of trying to raise more capital, and that's when they look at kind of a CF and a private raise as well to supplement that. The other piece that's important with the Reg CF is just the whole community piece. So it may not be as important from a financial amount side as far as what you're raising, but it's important to kind of build a community, leverage your community, and build a following, which has a lot of great implications for you down the road as part of future raises and kind of building a successful business as you grow.
Right. And that's a good segue into testing the water. So why don't you talk a little bit about what testing the water is and why is that important for Reg CF?
Yeah, so testing the waters is sometimes called a reservation campaign. It allows the issuer to, so to speak, test the waters prior to filing what's the Form C that's required for a Reg CF offering. A lot of times, if you're going through a portal, you have a campaign page that goes up. People can look at it. Allows them to kind of learn about your company, your product, the people behind it, investors, and a great way for them to get an understanding and decide whether or not that's something they'd be interested in once you go live. So they can make a reservation, which then is turned into a investment commitment after it goes live. You have 7 business days to do that, and you can convert into a actual commitment at that time. It's for me, it's a wonderful opportunity to kind of market your company, get your company out there, a lot of eyeballs on it. So the bigger platforms obviously get a lot of eyeballs that look at these different products that go up or issuers that go up. And so it's a wonderful way to kind of get exposure. It's not only almost free marketing in a way, because a lot of people are looking at it, allows them to kind of take a look and evaluate before you actually go live. The one thing that we've seen for us, at least anecdotally, and Eric, I'm sure you'll agree with this, is we think testing the waters is important. We think that it helps kind of get you off and running quick when you launch, which is important. So obviously there's some sites where if you get above a certain amount, you start trending. That's where it catches people's attention. So kind of getting off to a good start is very important, because if someone sees that you haven't raised much money in the first week or so, they'll likely think that there's something wrong, what they're missing, maybe it's not that interesting, and they may back away. But if something starts initially hot and starts getting up to 25,000 or more right off the bat, someone's like, "Whoa, that there's something there that's interesting. I may follow." It's kind of the herd mentality a little bit, right?
Yeah, I
And
like to.
so
No,
yeah,
sorry.
it's an important piece. And the only other thing I just want to add really quick is, like, for us testing the waters, we think it should be somewhere between 2 to 4 weeks only as far as time period. Because if you go too long, it can get a little stale, right? Someone keeps going to the site, keeps seeing you're up there, seeing the company up there is taking reservations, but then sees that nothing else is happening and says, "What's going on? Why is it taking so long?" You may forget about it, a whole number of reasons. And so then that can cause additional, concerns maybe from an investor. So, the longer you go, the less effective it is. And so from our perspective, a short 2 to 4 weeks is more than appropriate, we think, to just kind of get some momentum, let people see it before they make the investment decision.
Yeah, I mean, ultimately, I like to use the analogy of a train leaving the station, right? Because anytime you're trying to raise money, you're trying to get some momentum. People have to believe that there's something exciting about it, and there very well may be, but they also need sometimes to be convinced. So if you're at the train platform and you're trying to wave people in from a field to rush to get the train, if they start to come up to the train, they see rust forming on the tracks around the wheels. That's probably not a good sign. They may be like, you know what? I probably don't need to run for this train. You know what? I'll catch the next one. And you'll be like, no, 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 no. You got to catch this one. So I think the same holds true with, building that community base, testing the waters, getting the momentum. And again, the train analogy is particularly apt when you're on a funding platform, because there are people on those platforms, but what's going to attract their attention? Which trains are they going to try to catch? They're going to try to catch the trains that other people are going on. Like, if they don't know all that
Correct.
much about any of the individual trains, you want to build some early stage momentum going into it, or else they'll be like, hold it, do I really want to be the first person on this train? No. So and that's a very helpful way, I think, of looking at it. So before we start talking about our connection, for crowdfunding and maybe even touching on digital assets again, what are some of the more popular Reg CF platforms? I mean, we work, we work with, a number of them. Republic is very popular, the one that we see the most of, and we actually like their platform a lot. What are some of the other ones that we?
Well, there's Start Engine, there's WeFunder, Seed Invest, Dealmaker, which has a little bit different variation to it. There's a number of them out there, and they all have their pros and cons. Obviously, you can talk to anyone, and some will not like one, but they'll like the other. It's just, it's there's different kinds. They're all similar in some respects, but different as well. Republic generally has its own kind of template that it uses. WeFunder or Start Engine may offer more like an equity type of offering, and just different review processes in all of them. So they all have different flavors as far as it goes, and but definitely an area that obviously is hotter. And I should mention, just as we're on the subject, obviously all these portals, the nice thing about a Reg CF versus kind of a Reg D or a 4A2 in many respects is you can access people and get investments that are very low. So you can go like $100, $150 from people. Whereas obviously if you're doing like a Reg D or something like that, or a big section, 4A2 type of raise, those are usually 5,000 and above type tickets, which makes a big difference. So, to our point earlier, it's access, and you're trying to tap as many markets and people as you can to try to raise money to help grow your business. So you want to not exclude any areas if you don't have to.
Right. And
Yeah.
again, as we start to talk more about versus a digital asset, or even just anybody who's an early stage company, we are talking about primary issuance. We're not talking about secondary issuance. And one of the reasons why digital asset ICOs or SAFs or what have you have been popular is because it provides the opportunity for people who acquire those tokens to at some point engage in secondary trading without the issuer having to do a full blown registration. But but with that now sort of, I guess, in question, like in the U.S. The Reg CF is a way to raise that capital, continue in small increments, engage a non-accredited base, engage your community, and it doesn't mean that if the regulatory environment in the US strains out in a way that you're not subject to that jeopardy, you couldn't take advantage of it later on. You could arguably even provide for the ability to convert into a token that is a security or subject to an exemption from securities registration at some point in the future. Again, that side of the market hasn't really taken off to date, but it might in the future. Certainly going down this route, one that engages your community could be a lot better than worrying about enforcement or even potential investors later on asking, hey, are you definitively not a security? Why do you think you're not a security? Maybe we don't want to touch it because there's we think you might be a security. So these are considerations that you now have to weigh. And as Andy noted before, we are seeing an evolution in the kinds of clients that come to us, thinking of creative ways to achieve the same objectives as they may have originally thought about with their initial token offering, like a native token. And this works particularly well when there's actually a clear revenue model, either in the imminent or in the near term future, or one that they are building upon. So rather than leveraging revenue through a native token offering, maybe there's a fee or a commission for transactions occurring through the platform, again, assuming that they're not engaging in prohibited transactions. So we're also seeing traditional projects asking us about ways to incorporate tokens into their offering, even though they're traditional equity, like maybe like a NFT or some sort of perk that can be offered. A lot of platforms have the ability to also offer these perks that just by virtue of being the owner or having purchased, under the crowdfunding platform, you can take advantage of these things. So this is why if you have a community, it becomes particularly compelling. You can achieve some, maybe not all, of the dynamics. Another inherent limitation, though, is the globalization. A safe or even something that's convertible into an exempt from registration security in the future may not have that same global reach as if you were on an ERC20 token that can trade worldwide. Again, hopefully there might be some regulatory respite in the future that you can take advantage of and structure into. That might be one way of potentially looking at it. So again, these are these are considerations. It doesn't necessarily mean that a project has to say, oh, we're never going to issue a token we're never going to issue a native token. It just says, maybe right now isn't really the best way to do it. Maybe I can't, I don't have that level of confidence that I've achieved sufficient decentralization such that a regulator won't deem me to be a security, won't deem the project to be a security. So, that's an important consideration as well. I mean, some in the SEC would say if there's a group of people asking a lawyer about whether they can issue a token that's not a security, that's probably a good indication that they're not sufficiently decentralized, since somebody has to make that decision to list. Again, these are unfortunate considerations. I've talked in previous podcasts about like the Wahi case with the SEC, where the mere act of trying to put a token up for secondary trading on Coinbase was itself deemed to be an indicia that it was in fact a security. So against that kind of regulatory backdrop, it's very hard to know how things are going to roll for the small and early stage projects. And honestly, unless something changes with some of the things proposed from a legislative perspective, I don't see that respite coming anytime soon. I'd love to be proved wrong, though.
I would just add, obviously, as I mentioned, I think at the beginning, we do have a few issuers who are kind of taking the approach we're talking about and, raising capital for the holding company and reserving kind of down the road the offering of a token later on. But at the same time, working to build their community and using the CF to help them build their community. So when they do issue the offering, the token down the road, they have a community that's already kind of built and put in place, or at least has started to be put in place, which is very helpful for them. And the other piece that also I want to close the loop on is we were talking a little bit about financials before. And what we do see at times is some people start with reviewed financials, So they'll raise up to 1.235 million, and then they'll either switch to get an audit performed while that's happening, or they'll close that offering and then they'll do a subsequent one with audit financials to raise the rest up to 5 million. So I just want to make sure we mention those as part of our discussion and didn't miss those important points.
Excellent. Anything else we miss?
Nope, we're good.
Okay, so I guess the upshot for everybody listening is we're bullish on Reg CF as providing, for early stage ventures. We're bullish on it for being a temporary alternative for consideration for even digital asset space. We love when projects are able to sort of combine both like a Reg D or a 4A2 at the same time as a Reg CF, because that gives the optimal amount of ability to raise the capital without having to go through a full board registration. Reg CF is great for crowd. You want a community that's staked around you. You need all the help you can get. I think it goes full circle to what Andy was saying early at the beginning of the podcast about Knight. When the chips were down in their case, they learned how important their community was. And those people believed they were staked in other ways, but staking, you need all the help you can get to build it. It takes an army to build things sometimes. And, crowdfunding, I think, allows you to build out that army a little bit. And in conjunction with, if you have strategic investors, you use other methods for that. But again, I think when approaching capital raising, I always say one thing to our clients early. It's like when we're talking about raising money, it's like there's money and then there's money plus, and you always want money plus. Money plus is much better than money. You want to have that exponential aspect. You want to have that multiplier on that money by having the right parties engaged.
I think you summed that up really well, Eric. Clearly, if you, as this early, smaller companies looking that are growing, you want to try to raise as much capital as you can at any point in any avenue you can get, because the more money you have, the better chances you are going to be successful down the road. And, capital is hard to get. Most issuers of that stage will tell you, they spend an inordinate amount of time raising capital. So if there's ways for them to really get a bunch of it and make it easier for them to raise capital so they can focus on running their business, that's ultimately what the goal of all this is. And so they have a much better chance of them succeeding in developing their business product and their community, as Eric pointed out.
Excellent. So anybody want to learn more about what we do, we're at hesslegalcounsel.com. Obviously, theencryptedeconomy.com. That's another website. My email is eric@hesslegalcounsel.com. Go figure. Andy's is at, can you guess? I don't know. If you can't guess, then
hard to know.
I don't know what to say to you at this part of the podcast. But so anyway, that's it. Andy, thanks for coming on and talking about crowdfunding.
Thanks for having me.
Safes. Take care.
I enjoyed talking about it. And, obviously anyone has any questions or want to learn more, feel free, please, to reach out. We're very approachable and always happy to answer any questions and guide you along the way, because it's not, there's a lot of twists and turns that you just got to make sure you follow to make sure you do it all correctly and properly.
Yeah, excellent point. I mean, I probably didn't emphasize that enough. It's like if you're an early stage company and you're thinking about, hey, can I use, I was thinking about a native token, but can I leverage this to leverage the community? What are some creative strategies that we can use to sort of allow me to achieve some of my objectives without, running afoul of any regulation? I mean, again, sometimes you have to be more thoughtful in sort of devising this. Reach out, we talk. I take a lot of calls, and sometimes I just take calls because I help people. So there you have it. So thanks for listening.
We're happy to help.
Yep, 100%. All right. Take care, Andy.
Thanks for having us.
Bye.
Bye.